Now, market master of the day is Pankaj Tibrewal, fund manager equity at Kotak Mutual Fund. Pankaj, good to have you with us here, always on CNBC-TV18. Appreciate your time. You look at numbers very, very closely. And as they say, right, in the second half, some of the weaker numbers start to come through. Whether it's by design or accident, we don't know. But as the earnings season progresses, the beats keep decreasing, the misses keep increasing. Are you seeing that? And what's the overall trajectory so far?
Good morning, Prashant. It's very interesting to see the results season spanning out. We are almost halfway through. And let's decode the numbers which has been reported till yesterday. In the NSE 500 companies, about 214 companies have reported their results. 56 are BFSI companies and 158 are non-BFSI company. And some interesting trends are to be watched out. On the BFSI side, we have seen 14% earning growth. And on the non-BFSI side, we have seen degrowth of 3%. And the headline number is about 4% earnings growth on an aggregate basis. Compared to the first 9 months, I think you are seeing moderation on the banking and the financial results. This number in the first 9 months was about 35 to 40% earnings growth, which is now about 14% earnings growth. On the non-BFSI side, we are seeing margins starting to improve as the commodity headwinds are behind us, and we are seeing cooling of commodity prices, and hence you are seeing margin recovery. And in the first 9 months, non-BFSI segment, which is the large portion of NSE 500 companies, was negative 11%. We are seeing in the first half, almost where half of the reported numbers are there, we are seeing that at negative 3%. So clearly, quarter on quarter, you have seen margin recovery, and that's showing on the NSE 500 companies. On the Nifty, I think 31 companies have reported till day before yesterday. And the numbers are about 7.5% earnings growth on a headline basis. Metals and oil and gas have been a spoil sport. BFSI again has led the show with a strong earnings momentum.
Wow, that's a feast of numbers, Ravi, right? So,
absolutely, that's really the entire dashboard, so to speak. So, Pankaj, translate this into so how you're approaching the portfolio. Not that the approach will change every quarter with the season, but is there anything else that that you're incrementally changing in terms of the approach?
Surbi, one sector which has probably stood out overall has been pharma. There have been more beats compared to the misses which we have seen in the last 5-6 quarters. And if you also look at in the last 20 years, the pharma profitability pool as an overall profit pool is one of its lowest. So we believe that with increment changes being positive on the US front, domestic doing well, pharma could be a dark horse as you move into FY24. And some of the results, maybe early days, are indicating that worst may be behind in terms of earnings for the pharma sector. On the banking side, I think the earnings upgrade cycle has stalled. And that's what the reflection is in this quarter, that earnings upgrade cycle is not there. However, valuations continue to remain comfortable. And probably this year, the stock return should reflect the earnings growth rather than any PE expansion. On the capital goods side, I think the results have been quite good, and especially on the domestic-facing companies. And we have seen strong order momentum by most of the capital good names which have reported. And that gives us a conviction of our overall call on the manufacturing infrastructure and manufacturing and the capital goods sector. Coming on to, I think, consumption, I think FMCG has shown some kind of resilience this quarter, though there has been dispersion in the names, but many managements are calling out for bottoming out on the rural demand. And I think that's something very interesting after many quarters. And also on the margin side, we have seen gross margin recovery by most of the FMCG players. So that could also be an interesting sector to watch out. And don't forget, next year, same time around, we would have our general elections. And historically, we have seen that 6 months before the election and 6 months after the election, FMCG is one sector which probably does well from an earnings standpoint of view. Also, on the discretionary and home improvement, though there has been dispersion again in the sector, we are seeing early signs of recovery, and probably the worst of the margin pressures could be behind them. And starting June and September quarter, you should see some recovery. Last but not the least, I think IT sector is an interesting sector to watch out. Almost 15 to 18 months have gone by where this sector has underperformed. Valuations for the large caps probably are in average of 10-year average, and mid caps may be slightly at a premium still. But we believe that worst probably on earnings should be behind it. Probably one more quarter in September quarter, but markets are smarter than all of us. They kind of bake in slightly ahead of the bottoming out. And this is one sector we are keeping a close watch, because to refresh everybody, I think this sector has been the biggest wealth creator over the last 2 decades. And the profit pool to overall profit pool is about 9%. In COVID times, we have seen IT sector profit contribution has moved up to 14-15%. From there, we are down to 9%. And probably at some point of time, it will warrant a look. And probably we'll look from an overall perspective.
All right. Hi, Pankaj. You briefly mentioned elections and that, the general elections. What about the state elections? Do you think it'll be a one-day reaction wonder, or do you think the market will read through if in case the current ruling government doesn't hold its ground in Karnataka?
So we have seen, Nigel, that elections are a short-term phenomena. And over the longer periods of time, it's the corporate performance, reforms, continuity, which plays a major role. I think if any disappointment is there and markets kind of correct, I think it will be an opportunity. And we believe that 18 months have gone by where markets have given no return. And it's a good, healthy phase where after a very strong up move, we have seen consolidation. I think if market gives you that opportunity, I think we should look to increase our equity exposure over the next 6 months. It could be a domestic event, it could be a global event. But my sense is that over the next 2 quarters, earnings should bottom out. From September quarter onwards, we should start seeing earnings upgrade momentum starting off, because a lot of companies will see low base and margins probably worst is behind us. Only thing we should keep in mind that this year could be a year of top line miss. Don't forget that last 2 years we were supported by the healthy WPI inflation. Now WPI inflation is down to below 2%. So the corporates won't have that lever from a top line growth perspective. And probably most of the street analysts are expecting a linear growth in top line for most of the corporates. Our worry is that that could be one point we should be a little wary of, because inflation is missing, and if volume growth doesn't pick up, there could be some kind of a disappointment on the top line side.
Pankaj, you did mention capital goods is one of the sectors where you're seeing positive traction. And if I remember correctly, I think as a house, Kotak has always had a favorable view on the capex cycle plays, cement, and the related spaces. But just your thoughts. I know you won't talk individual stocks, but I'm asking more from the point of view of maybe a signal for the sector. I mean, this whole sort of debate around L&T, we saw what happened to the stock yesterday, margins coming under pressure. And, one of the experts that I was speaking to raised a very valid point, saying when you're in an upcycle, when there's a huge amount of tendering and contracts being given out, if then you can't command good margins, then when will it ever happen? I thought that was it was a strong point of debate. But just your thoughts on capital goods, and you have companies like Siemens, ABB, the industrial automation part of it, where the numbers at least seem to be far better. So how are you looking to play it?
So Surabhi, if you look at, margins are the last to recover in a capital goods cycle. What margins you are seeing are the orders which were taken a couple of years back, and they are getting executed now. And also don't forget that there was a huge headwind of commodities in the last 18 to 24 months. What happens in a capital goods cycle is that when the economy starts recovering, you first intake a lot of orders. And once your order book is full, and the book-to-bill ratio is 2.5, 3 times, and you have enough visibility for the next few years, you become very selective on the order booking. And then you try and choose high margin orders versus low margin orders. So generally, it's that first, the parameter to track capital goods is look at the order inflows. Is it getting very strong? The second is followed by the top line growth. And finally, the margins, which kind of come in at a later stage in the cycle. I believe that the order inflow growth for most of the companies have been very strong, and the commentary and outlook also remains to be strong. I think it will be followed by a strong top line growth this year, and margins will be probably towards the latter half of this year or early part of next year. So I'm not, or we are not too concerned about a miss in margins in a couple of names, but the broader commentary and trajectory remains to be still strong.
Okay, got that. Pankaj, a pleasure listening to you as always. Thank you very much for joining us today on the show. You have a good weekend, and we look forward to our next conversation.